Let's now join Bill Keogh, who's standing by at FIG Securities in Sydney. Bill, have you found that the Australian dollar, the high Australian dollar, has actually been affecting the term deposit market?
Yeah, good morning, Brooke. Well, it's certainly a factor for the offshore investors. What we've seen is our rates are very attractive. In fact, they're one amongst the most attractive rates in the developed world. You've got say a one-year term deposit rate of in the mid-sixes, 6.5, underlying inflation 2.7, so you've got a real rate of return around 4%, which is very attractive. I think, but again, I think that's been our interest rates have definitely been a factor, along with lots of other factors such as commodities, which have driven the dollar to all-time highs this week of 105.
So, I mean, that's offshore investors. What about domestic investors? Are you finding that the movement in the currency is actually directly affecting the kind of rates that we can get as Australians here?
No, well, not really. What's happened is with the Aussie dollar going up high, it's actually a deterrent for offshore flows of cash coming onshore. So therefore, there's demand still in our domestic economy for banks to raise funds through the term deposit market. And remember, it's easy for domestic investors. They simply buy a term deposit. They're getting an attractive rate of return at no capital risk, and an added bonus is actually the government guarantee still in place for deposits under $1 million. So those factors are certainly supporting the deposit market.
Yeah, so if you've got less money coming from offshore investors, how do you find that actually affects funding for banks, for their actual funding requirements?
Again, I think we've been pretty consistent with our view that the banks, building societies, credit unions, so all the approved deposit institutions, they have got a requirement to fund their books. They either fund their books from offshore or onshore. And if there's cash lacking coming on from offshore onto onshore, well, therefore, logic would tell me that there's still a demand for deposits and term deposits for this ADI sector.
We have spoken in the past about the volatility in equity markets, I suppose. We've seen a pullback yesterday, fairly flat today. What are you suggesting to people in terms of who will be the better performer, fixed income or equities at this stage?
Yeah, okay. Again, Brooke, I'm not saying that fixed income is going to outperform any asset class. Our consistent view has been there's been flight to safety. So out of shares into the likes of term deposits. I think the real debate is this going to be a short-term phenomenon where people are just sitting on the fence and looking to reinvest back into equities and other asset classes? I suggest that probably it's a medium-term change in the asset allocation of the underlying investors. So they're putting more money into defensive assets such as fixed income and cash.
You mentioned the federal government term deposit guarantee, I think just briefly earlier. It's due to expire in October this year. What do you expect happens after that point?
Yeah, and that's a really good question, Brooke, and I did mention the government guarantee, and it's only 6 months until that expires. So it was put in place, the free government guarantee for accounts, deposit accounts up to $1 million in October 2008. Due to expire in October 2008, this year, 2011, and Wayne Swan, our Treasurer, was in the banking reform legislation at the end of last year. Him and the government are committed to keeping this guarantee in place, but the big question is it going to be $1 million threshold, or is it going to be a lot less? And it's bizarre that we haven't heard anything in the first quarter. Only 6 months ago, and I'm sure a lot of investors and a lot of the ADIs are very concerned about what the limit will be.
Bill Keogh, thanks so much for joining us from FIG today.